I have watched markets for decades. I have sat in bucket shops as a boy, reading the tape while grown men around me lost everything they had ever earned. And I learned something early, something most traders never learn at all. The market does not move because of news. It does not move because of earnings reports or central bank decisions. The market moves because of human beings who are afraid, human beings who are greedy, human beings who hope when they should accept and panic when they should hold still. The candlestick is nothing more than a picture of that psychology. Every candle you see on a chart is a confession, a record of every decision, every fear, every capitulation, and every surge of confidence that happened inside a specific window of time. If you can read those confessions, you will never need to guess where the market is going. You will simply know. Most traders look at charts and see noise. They see lines going up and lines going down, and they try to impose their opinion onto that movement. That is the beginning of every great loss I have ever witnessed. The successful trader does not impose. He observes, he waits, he lets the market speak first, and then he responds with precision. The candlestick is the language the market speaks. And today, I am going to teach you to understand it completely. Let us begin with the most honest candle in the market, what the Japanese called the marubozu. No wicks, no indecision, just a full body from open to close. When you see this candle, the market is not whispering, it is shouting. It is telling you that one-side buyers or sellers took complete control from the first moment to the last, with no hesitation and no resistance. I have always said that the market tells you what it wants to do if you stop telling it what you think it should do. The marubozu is the market's most direct statement. Take it seriously. When a bearish marubozu appears in a downtrend after a brief consolidation, do not fight it. Do not look for reasons to believe in a reversal. The sellers are in command. Follow the command. Now consider the opposite of that conviction, the doji. The doji opens and closes at nearly the same price, forming a thin cross. Where the marubozu is certainty, the doji is a question. It is the market pausing, breathing, reconsidering. In my years of trading, I learned that the most dangerous moment in any position is when the market goes quiet. That silence is rarely neutral. It is preparation. When a doji appears in the middle of a strong trend, it is the trend gathering itself before the next move, an opportunity for you to add to your position with confidence. But when a doji appears at the top of an extended move or the bottom of a sustained decline, it is a warning. The dominant side is losing its conviction, and the other side is organizing. Do not ignore that warning. The market always gives you a signal before it turns. The doji is one of them. There is a candle I have watched save fortunes and destroy them in equal measure, the hammer. The Japanese called it the tonkachi. It appears after the market has fallen hard, and it tells a story that any student of human nature would recognize immediately. The sellers pushed the price down with force. They believed they were in control. And then something happened. Buyers came in quietly, but with enormous conviction, and they drove the price all the way back up to where it opened. That long lower shadow is not decoration. That shadow is evidence of a war that the sellers lost. The longer the shadow, the more decisive the defeat. When you see a hammer forming at a level where price has respected before, that is not coincidence. That is the market confirming what the structure already told you. Price is not wanted at those lows, and I have never made money fighting what the market refuses to accept. Watch this same logic work in reverse with the nagare-boshi, the shooting star. After a strong rally, a candle with a small body at the bottom and a long upper wick, buyers reached for higher prices. They pushed, and sellers came in and crushed them completely before the candle closed. That upper shadow is a rejection. It is the market saying, loudly and without ambiguity, that price is not welcome at those highs. I once said that there is only one side to the market, not the bull side or the bear side, but the right side. The shooting star tells you which side is no longer right. Get off it immediately. Now I want you to understand the engulfing pattern, what the Japanese called the tsutsumi. When a candle completely swallows the body of the one before it, you are watching a transfer of power in real time. The prior candle's emotion, all of it has been absorbed and overrun. A bullish engulfing after a decline does not merely suggest that buyers are present. It confirms that buyers have taken everything sellers offered and still had force to spare. That is not a small thing. That is the kind of energy that builds new trends. And a bearish engulfing at the top of a rally is the same message in the opposite direction. Sellers arrived with such conviction that they erased an entire session of bullish progress in a single candle. Before you go any further in this course, I want you to do something. Go and watch our video titled The Art of the Entry, Reading Candlesticks Like a Professional Trader. It will give you the technical foundation that makes everything in this course sharper. Understanding when to enter is inseparable from understanding what the candle is telling you. These two videos work together. Now let us continue, because the real power of candlestick psychology is not in any one candle. It is in the patterns they form together, and that is exactly where we are going next. Like this video, share it with someone who trades, and leave a comment. Tell me which candle you have been misreading your entire trading career. Individual candles speak, but patterns, sequences of candles working together, those tell entire stories. And it is in those stories that fortunes are made and lost. In my own career, I did not simply read tape or track price levels. I read the market's narrative. I asked what the market had done, what it was trying to do, and whether it was succeeding. A single candlestick pattern answers the first question. The structures that emerge across multiple sessions answer all three. This is what the great Japanese rice trader Munehisa Homa understood 3 centuries ago when he developed the Sakata 5 method, a framework so psychologically precise that it has survived every market era, every instrument, and every form of manipulation that institutions have since invented. The first structure within the Sakata method is Sanzan, the 3 mountains. You will recognize it immediately as the triple top. 3 attempts to push the market higher, 3 failures. And with each failure, something is happening underneath the surface that most traders miss entirely. Buyers are not simply losing, they are becoming exhausted. Each push to the high costs them more energy and yields them less result. By the third peak, the conviction that fueled the rally is gone. What you see on the chart is not just a pattern. It is a psychological biography of a trend that has reached its limit. When I saw a market forming 3 distinct highs at roughly the same level, I did not need an indicator to tell me what was coming. The market had already confessed. Sellers were absorbing every attempt, and buyers were running out of ammunition. The reversal was not a prediction. It was an inevitability. The mirror of this is Sansen, the 3 rivers, or what we now call the triple bottom. 3 attempts to push price lower, each failing to hold. By the third low, sellers are spent. They have tried 3 times and failed 3 times. And in those failures, buyers have been quietly building their positions. This is accumulation in its most readable form. The market does not crash immediately from these lows into a new bull run. It hesitates. It forms small candles. It drifts sideways, and that hesitation is not weakness. That is the compressed energy of a reversal preparing to release. The triple bottom is not a buy signal the moment the third low forms. It is context. It tells you that the structure favors buyers, and you now need one more thing, a confirming candle before you commit your capital. This is where the Tsutsumi, the engulfing pattern, becomes your most reliable execution tool. When a triple bottom forms and the market then delivers a bullish engulfing candle, particularly one that closes above a prior resistance level or sweeps a liquidity pocket, first you are looking at one of the highest probability setups in trading. The triple bottom gives you the structural context. The engulfing candle gives you the confirmation. And if you layer in a modern understanding of where institutional liquidity sits, the stop orders clustered just below those triple lows, you will see that the market often sweeps those stops before reversing, ensuring that the weak hands are shaken out before the real move begins. That is not manipulation to be feared. That is information to be used. I want to address the harami here, the inside bar, because it is one of the most misunderstood patterns in all of technical analysis. When a small candle trades entirely within the range of the previous candle, traders often panic. They see it as weakness, as drift, as the trend losing momentum. And sometimes they are right. But inside the right context, the harami is not weakness at all. It is the pause that precedes acceleration. When a market breaks out of a consolidation range and then immediately forms an inside bar, that inside bar is the market testing its own conviction. It is asking, was that breakout real? Traders are cautious. Volume thins, and then the range of the inside bar is broken in the direction of the new trend, and the market answers its own question with force. I have built some of my largest positions on that breakout. Not because I guessed it would happen, but because I understood what the inside bar was saying, that the trend was digesting, not dying. The three soldiers pattern San Piege in the upward direction deserves particular respect. 3 consecutive strong bullish candles, each closing near its high, each opening within the body of the one before it. This is not random. This is conviction compounding. When buyers are so confident that they refuse to let price retrace between sessions, you are watching institutional accumulation playing out in real time. Sellers are present, but they are being absorbed. And with each candle that closes near its high, more sellers capitulate and more buyers enter with increasing size. The three soldiers do not appear at major bottoms very often. When they do, they are worth noting with the highest possible attention. If you want to understand how these patterns connect to the broader discipline of reading market character, when to act and when to wait, go and watch our video, How to Align with the Market and Let Profit Find You. That video will show you what I spent years learning, that your job as a trader is not to predict. Your job is to align. These patterns make alignment possible. They show you what the market already knows, and they show it to you in a language clear enough to act on with confidence. Share this video right now with anyone in your trading community who is still confused about why patterns work. The answer is not technical, it is psychological, and that distinction changes everything. Leave a comment below and tell me which Sakata pattern you have seen most recently on your charts. I have told you about the individual candles. I have told you about the patterns. Now I want to tell you about something that most trading educators will never say out loud, because most of them have never actually traded with real money on the line. The patterns do not work because the market is mechanical. They work because human beings are mechanical. Every generation of traders believes it is the first generation to face something new. They point to algorithms, to high-frequency trading, to central bank intervention, to social media sentiment, and perhaps those things change the speed at which patterns form. But they do not change the underlying psychology that creates them. Fear looks the same in every era. Greed looks the same. Exhaustion and capitulation and irrational hope look the same, whether the year is 1907 or today. The candlestick is a mirror held up to human behavior, and human behavior does not evolve on the timescale of a trading career. This is why the combination of ancient candlestick psychology and modern market structure creates something genuinely powerful. The Tonkachi, the hammer, identifies the moment buyers reject lower prices. A fair value gap, the imbalance left behind by a powerful institutional move, identifies where price is likely to return before its next impulse. When a hammer forms inside a fair value gap, you are not simply looking at a reversal candle. You are looking at institutional buyers defending a specific level where they previously entered in size. That confluence is not accidental. It is the fingerprint of smart money, and the hammer is the candle that confirms they have returned. Let me walk you through the execution discipline that separates professional traders from gamblers, because the patterns are only half the equation. Entry is a science. The candle that triggers your entry must be one that closes, not one that is forming. I have seen traders enter mid-candle, mistaking momentum for confirmation, only to watch the wick extend and stop them out before the move began. The close of the candle is your signal. That close represents the final verdict of every participant in that session. Before that close, everything is argument. After it, the market has spoken. Your entry is placed at the close of the confirming candle, the engulfing bar, the hammer at the gap, the inside bar breaking in the direction of the trend. Your stop loss is placed just beyond the extreme of that pattern, below the liquidity sweep or below the fair value gap, not above your comfort level, below the market's structural evidence. And your target is the next meaningful level of resistance, a prior high, a supply zone, a major structural level on the higher time frame. The higher time frame is not optional. It is not an advanced technique reserved for experienced traders. It is the first step. Before you look at a 5-minute chart, look at the 30-minute chart. Ask what the larger structure tells you. If the 30-minute chart shows a market that has broken out of consolidation and is beginning a new bullish leg, then the 5-minute entries aligned with that direction carry institutional momentum behind them. You are not fighting the trend. You are joining it at the optimal moment, confirmed by both ancient pattern recognition and modern structural analysis. This is what Homer understood centuries ago, and what I applied to the New York markets in my own career. Multiple time frames are not redundancy, they are clarity. Here is something I want you to understand about patience, because without it, none of the patterns in this course will save you. I have watched brilliant men with deep understanding of markets destroy themselves because they could not wait. They understood the pattern. They identified the level. They saw the setup forming and they entered 2 candles too early, got stopped out, and then watched the market move exactly where they predicted without them. The entry is not just a price, it is a moment. And most of the discipline involved in trading is the discipline of waiting for that moment to arrive and then acting on it without hesitation. The market does not reward those who understand theory. It rewards those who understand theory and then execute with patience and decisive conviction when the signal appears. This entire course has been built around a single truth that took me a lifetime to fully embrace. The market is not your enemy. It is a reflection of every participant's psychology, playing out in real time, leaving visual evidence with every candle it prints. Your job is not to predict it. Your job is to read it, align with it, and let it carry you. When you see the 3 rivers exhausting the sellers, when you see the engulfing bar confirming the reversal, when you see the 3 soldiers marching in the direction of the new trend, you are not looking at patterns on a screen. You are watching human psychology reveal itself exactly as it has done for centuries, exactly as it will continue to do long after you and I are gone from these markets. Go and watch the signs you're finally becoming a profitable trader. It will help you identify the mental shift that separates those who apply these patterns profitably from those who recognize them but still find ways to lose. That video and this one belong together. Watch them both, and then return to your charts with different eyes. If this course gave you something real, I want you to like this video. Share it with every trader in your circle who is still searching for a framework that actually makes sense. And subscribe to this channel so you never miss what comes next. Leave a comment below, tell me one thing in this video that changed how you see the market. And finally, if you want to take this work deeper into your own psychology as a trader, we have 2 resources waiting for you in the description below. The first is Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. The second is The Livermore Journal, a 90-day trading psychology workbook. 90 days of structured self-examination designed to build the habits, disciplines, and mental frameworks that profitable trading demands. Both are in the description. Get them. Use them. The market does not care about your intentions. It only responds to your actions. Make yours count.